Sydney is a vibrant, fast-growing capital city, home to some of the best lifestyle factors in the entire world. Its economy is a beast, producing nearly $500 billion in economic output each and every year. Its population is 5 million and rising quickly. It also is a landlocked city. It cannot continue to go out indefinitely forever and needs to start going up. This combination of factors, being landlocked, rising population, strong institutions, and a strong, diversified economy, makes it a very attractive place to invest for Australians and citizens all around the world. But does that make it a good place to invest in 2023? In our last video, we unpacked some of the financial issues plaguing valuations of Sydney property prices at the moment. It's unaffordable. It's expensive based on previous historical benchmarks, and the rent-to-buy equation, which has been an indicator for housing valuations over the past 30 years, presents red signals at the moment, actually spitting out the worst outcomes in 50 years right now. Does that mean you shouldn't invest in Sydney? Not necessarily. There's a lot of positive and negative factors going for it. In this video, I'm going to go through some of those positive factors to underline why Sydney is a beast and has produced stunning results in 2023, with prices rising nearly 10% alone this year, despite all the gale forces of fixed interest rate cliffs and interest rate rises that have hit the Sydney property market this year. Specifically, I'm going to look at 4 factors. I'm going to go through, firstly, the listing levels and distressed listing levels in Sydney. I'm going to unpack the employment market in Sydney, and I'm also going to cover the rental market too. Finally, I'm also going to look at population levels in Sydney and how it tracks today and how it looks like in the years ahead. Stick around to the end because you're going to get a full assessment of the Sydney property market, both the downside factors that I talked about previously and the upside factors that are driving the Sydney property market today and into the future. Hi, I'm Riyadh Sayed, founder of Confidence Finance, 6 times top 100 mortgage broker, and I've had the pleasure of working with thousands of property investors and home buyers all across the country to help them build, scale, and grow their property portfolio. If you're looking to grow wealth through property and need a money person behind you, we're your finance partners, your mortgage brokers to help you achieve your dreams. If you're interested in property, finance and economics, and the housing market in general, hit that subscribe button. Definitely keep watching because this video is for you. So let's get into it. 1. Distressed listing levels. If you watch the media, you'll hear all the scaremongering. You'll hear about the fixed rate cliff, you'll hear about high interest rates, and you'll hear about how people are being forced to sell their homes. Check this out.
We've seen a lot of stock that's recently come on that has turned over in the last 1 to 3 years.
It's practically a brand new home and it's on the market.
As borrowers battle rising mortgage repayments, some are facing a tough reality.
But is this true? If you look at distressed listing levels in New South Wales, and in particular Sydney, you'll see that they've barely risen at all. In fact, they're down over a 3-year period. Now, measuring distressed listings is actually really tricky to do, but you'd expect with all the fixed rate expiries, the low assessment buffers that APRA previously had, the number of borrowers who over-leverage, that there'd be more people in distressed listing. Currently, we haven't seen that play out. Another thing that the media is purporting is a story about increased listing levels. That is, people are being forced to sell their homes or people are just deciding to sell anyway.
Sydney's property market has been flooded with homes for sale, according to the latest data, with the city setting a new record for the month of July. But many buyers are still struggling to get their foot in the door, some saying it's easier to find a home in New York.
Now, part of this is true. You'd kind of expect that after property prices have risen so much so quickly and interest rates are this high. A lot of people are out there thinking, hey, maybe it's a decent time to sell and get some money out of Sydney, help my cash flow. This is total listing levels in Sydney. Yes, they're up a little bit in 2023. You'd expect that for the reasons I've just touched on. But over a 10-year plus period, if you take a look here, they've barely risen at all. Sydney is a much, much, much bigger city now than it was in 2013. It has over 1 million plus more people. Yet we're selling the same amount of homes as we did back then. That's concerning. It points to a bigger issue, which is what we'll look at in terms of housing turnover. This is a structural supply side issue. People are simply holding onto their homes for longer periods of time, and and fewer people are selling. The reasons for that are a little bit unclear. Real estate agents won't like it, but this is what the RBA have, and they've measured this out. Other research institutions have looked at the average tenure of ownership, and that's also rising. But in general, housing turnover rates are really, really low, making up 4% of total turnover, and lower than they were in percentage terms than pretty much at any point in this chart itself. So you have a general picture of listing levels, no distressed listing levels, total listing levels pretty low despite it rising in 2023, and a general structural issue with listing levels in general. People simply aren't selling their homes. So this is one of the main pro factors for the Sydney housing market.
Well, the biggest factor driving prices higher simply comes back to supply.
Secondly, let's look at population growth. This has been one of the big drivers of Sydney property in 2023. We've had to home over 100,000 new people in Sydney alone. If you take a look at this, most of this is from overseas migration. We've brought in nearly 160,000 people in the year ending 31 March 2023. The numbers have consistently stayed strong for the rest of 2023 too. This has driven Sydney property prices because it's driving so much demand. Population growth rates are at near decade level plus highs. In the long run, you also have really strong population dynamics in Sydney. This is what a chart looks like from the New South Wales Planning Authority. If you look at it, it looks like an exponential rise. And if you think about it, these people need homes. So in 2016, we had a population of 7.75 million. And, in 2041, 25 years later, we have nearly 10 million people. That's 2 million plus people that we need to house. We're adding in 85,000 plus people every year over the next 25 years. And this year, it's been 100,000 plus. So this is the structural factors that support Sydney house prices, both in the short term and in the long run. You see that people are selling their homes less, the turnover of homes is less, and population rates are rising. What that means is you have a city where there's very limited new housing stock potential and you have a rising population. That combination is a really positive fundamental for Sydney housing. Let's get into the third factor, employment. Look at unemployment rates in New South Wales. It's been a huge driver of the 2023 boom. Expected unemployment to increase far quicker in Sydney in particular in 2023, but it simply has not happened. We still have some of the best employment metrics in 50 years. Sydney's unemployment rate is 3.4%. Very, very low, and near historical 50-year lows. You can see more recently, unemployment has started to tick up, and this is the main metric to watch for 2023 and 2024. What happens to employment is a huge driver for the Sydney housing market. In fact, I have it as the number one driver in 2024 and 2025. If the employment market holds steady and doesn't deteriorate too much, we do expect some deterioration, but if it doesn't deteriorate too much, then Sydney property values will likely continue to grow, albeit at slower rates in 2023. So what does this look like going forward? Now, forward-looking indicators suggest that the employment market is starting to weaken. The RBA have liaison with businesses, and those liaisons are suggesting that while it's still very tight and while they have capacity to raise prices because demand is fairly strong and getting workers is still somewhat difficult in some sectors, that other sectors, particularly financial services and other more seasoned sort of workers, professionals, those sectors are starting to experience some employment slack. You see this in youth unemployment rates, actually. If you think of that one, it's because graduates enter the workforce and in a really hot jobs market, they easily get a job and the youth unemployment rate reached a low level as well. But now it's starting to rise again because graduates who have no experience are trying to get into the labour market and they're struggling more so today than they were last year. If you look at employment intentions, the AFR came up with this one today. The employment intentions, in terms of redundancy intentions, that's basically doubled in the last 6 months. So that's quite concerning. The intentions of businesses, this is just survey data, but the intentions of businesses have seen a doubling in the number of businesses that are looking at creating some redundancies in 2024. So forward-looking indicators suggest that the employment market, which is the thing to watch when it comes to Sydney property prices, is starting to weaken. How badly it gets is going to really drive what happens to the Sydney property market in 2024 and 2025. So watch employment in Sydney extremely closely. We'll do more and more content, more and more podcasts on this and look at it very closely through 2024. Okay, so the fourth factor I want to look at is the rental market. In Sydney, this has been gangbusters. In fact, if you look at asking rents, in 2020, they began in the early 600 range. Since then, for houses, for a median house, they've clipped past $1,000 per week now. That's an enormous rise, and it's the number one reason why property valuations have maintained back at peak levels, even though interest rates have gone up so much. If you think of it simply, housing has an income, and that income is rents. If rents rise dramatically, it makes the income of housing go higher, and the fundamental value of that asset is now higher. Offsetting that is holding costs, with interest rates rising more than the rental growth, and that's why overall house prices haven't shot up and really stayed at their 2022 peak level, after the yo-yo down and back up. The main reason for that, offsetting these rate rises, has been this enormous rental increase in Sydney. This may continue too, because vacancy rates are very, very low. In fact, they're the lowest on record, just about. You can see it here. Current vacancy rates, early 1% range. It's never really been there before. It looks like it was there in 2006, 2007, temporarily. But for a really long time, we haven't had vacancy rates this low. So if you think of it, we've already taken up all of the excess stock in Sydney. All the extra people coming into Sydney need a home to live. There were some homes available, and that's why the vacancy rate was, 4% 2 years ago. But now that's come down to below 1%. So there's no excess housing available. And if we continue to bring in more people and there's no homes for them to buy, that's a fairly potent combination for prices. That's what's happened in 2023. But will it continue in 2024 and beyond? That's part of the framework that we're looking at. So there's my take across 4 main metrics for the Sydney housing market. But what does it mean overall? This is a really accurate summary of what's happened.
High demand as well as rising rents and property prices. That's the dire picture of Sydney's housing market.
Now, if you look at asking prices, you're starting to see that the Sydney property boom is just about over. They've shot up in 2023. You can't really see on this chart, but they've gone up roughly 10% in 2023. But more recently, asking prices are now coming back down. Auction clearance rates are now coming back down. We're starting to enter a much more balanced market. So my take is this 2023 Sydney property boom is over. But that doesn't necessarily mean that Sydney is a bad place to invest overall. Overall, I do think there are better capitals to park your money in the short run. But in the medium, long term, there are specific types of Sydney assets that will do extremely well, benefiting from the structural factors that I talked about in this video. Did you enjoy this video? Hit that subscribe button, hit that like button, and definitely tune in for the next one. Thank you.